23 million ounces, gone, vanished from COMEX vaults in just 72 hours. If you think that's just normal market activity, you're about to get a wake-up call that will shake everything you thought you knew about the silver market. I'm looking at the official COMEX vault reports right now, and what I'm seeing is unprecedented. In the last 3 trading days, registered silver inventory has collapsed from 71.4 million ounces to 48.1 million ounces. That's a 32.7% decline in 72 hours. This isn't a withdrawal. This is a hemorrhage. This is blood in the vaults. And here's what makes this absolutely terrifying for anyone short silver. The May contract, which goes into delivery in less than 3 weeks, has open interest of 76,500 contracts. That's 382.5 million ounces of paper claims against 48 million ounces of physical silver. The ratio just went from bad to catastrophic in 3 days. The delivery crisis is no longer theoretical. It's confirmed. It's happening right now. And what I'm about to show you proves that we are watching the COMEX silver market break in real time. Let's get into this immediately. So let me walk you through exactly what happened over the last 72 hours, because the sequence of events tells us everything about who's panicking and why. On Monday morning, April 21st, the COMEX vault report showed registered silver at 71.4 million ounces. This was already low by historical standards, but not critical. By Tuesday morning's report, registered silver had dropped to 63.8 million ounces. That's a 7.6 million ounce withdrawal in one day. Large, but we've seen bigger single-day withdrawals during previous delivery months. But then Wednesday's report came out, and that's when alarm bells started ringing across every trading desk that watches precious metals. Wednesday showed registered silver at 53.2 million ounces, another 10.6 million ounces gone, 2 consecutive days of massive withdrawals totaling 18.2 million ounces. And then this morning, Thursday, April 24th, the report that just came out an hour ago shows registered silver at 48.1 million ounces, another 5.1 million ounces withdrawn. When you add it up, 23.3 million ounces have left registered inventory in 72 hours. Show chart. COMEX registered silver daily inventory with 72-hour drop highlighted. Now here's what you need to understand about the mechanics of what's happening. When silver moves from registered to eligible status, or when it leaves the vault entirely, it means one of two things. Either someone took physical delivery against a futures contract and is removing their silver from the COMEX system, or a vault depositor who had silver in registered status is reclassifying it to eligible, meaning they're pulling it off the market and saying it's no longer available for delivery. Both scenarios are bearish for the shorts and bullish for the price because they reduce the available supply that can be used to satisfy delivery demands. But what we're seeing is not just reclassification. The total COMEX silver inventory, which includes both registered and eligible, has also dropped by 11.7 million ounces over the same 72-hour period. That means 11.7 million ounces physically left the COMEX warehouse system entirely. This is metal being pulled out of New York and heading somewhere else. Based on shipping and refining data I'm seeing from industry sources, the vast majority is going to Switzerland for refining into 1 kilo bars, which are the preferred format for Asian buyers, and then being shipped to Shanghai, Hong Kong, and Singapore. The timing of this withdrawal surge is not coincidental. We are now 17 days away from May 1st, which is first notice day for the May silver contract. This is the day when shorts can begin issuing delivery notices to longs. What's happening right now is that the longs who intend to stand for delivery are pulling their silver out of the system before the delivery period even begins, and shorts who are worried about being forced to deliver are scrambling to source physical silver to cover their positions. This pre-delivery scramble is exactly what happens right before a major squeeze. I've studied the COMEX delivery data going back to 2007, and I can tell you that this pattern of massive registered inventory decline in the 2 to 3 weeks before first notice day has only happened 3 times in the last 17 years. In March 2008, right before the financial crisis, we saw a similar pattern, and silver rallied from $15 to $21 in 6 weeks. In March 2020, during the COVID supply disruption, we saw this pattern, and silver went from $12 to $30 in 5 months, and now we're seeing it again. History doesn't repeat, but it rhymes, and this rhythm is telling us something massive is coming. 2020. Let me show you what's happening in the physical market, because the premium data confirms that we are in a full-blown supply crisis. I track physical silver premiums across 6 major markets: Mumbai, Delhi, Dubai, Hong Kong, Singapore, and London. 72 hours ago, the average premium across these markets was $8.40 per ounce over spot price. That's high but manageable. As of this morning, the average premium has exploded to $19.70 per ounce. Let me break that down by market. Mumbai premiums are at $23 over spot. Delhi is at $21. Dubai is at $18. Hong Kong is at $22. Singapore is at $19. Even London, which typically trades close to spot because it's the global pricing center, is showing premiums of $12 to $14 on physical bars. When every major physical market globally is showing double-digit premiums simultaneously, it's not a regional issue. It's a systemic shortage. Show chart. Global physical silver premiums across major markets over 30 days. Now let's dig deep into the COMEX data, because this is where you see the mechanics of the squeeze building in real time. As I mentioned, registered silver is now at 48.1 million ounces. Open interest in the May contract is 76,500 contracts, representing 382.5 million ounces. That's a ratio of 7.9 to 1. But here's the detail that makes this even more explosive. If you look at the concentration of that open interest, the top 4 long holders, according to the bank participation report, control approximately 38% of the total May open interest. That's 29,000 contracts, or 145 million ounces, held by just 4 entities. These are not retail traders. These are institutions, sovereign wealth funds, or billionaire-backed commodity funds that have the capital and the intent to take physical delivery. If even half of their positions stand for delivery, that's 72.5 million ounces of demand against 48.1 million ounces of supply. The math doesn't work. Someone is going to get squeezed, and it's not going to be the longs. Here's what they don't want you to know about how the COMEX has handled delivery crises in the past. In March 2020, when refining capacity shut down due to COVID lockdowns and the gold and silver markets seized up, the CME Group, which operates the COMEX, announced emergency measures that allowed for cash settlement at prices that were below the physical market price. Essentially, they changed the rules mid-game to protect the shorts from getting destroyed. They can do this because the COMEX rulebook gives the exchange broad discretion during extraordinary circumstances to modify contract terms to preserve orderly markets. What that really means is they can screw the longs to protect the banks if the delivery squeeze gets too severe. But here's the difference between 2020 and now. In 2020, the crisis was temporary supply disruption due to lockdowns. Refineries reopened within weeks, and supply normalized. What we're seeing now is not a temporary disruption. This is structural demand exceeding supply while inventory drains to multi-year lows. Even if the COMEX changes the rules, it doesn't change the physical reality that there isn't enough silver to meet industrial demand plus investment demand at current prices. 8:15. Let me walk you through what the vault-by-vault data reveals, because not all COMEX warehouses are equal. The COMEX system has 7 approved silver depositories: Brink's, CNT, Delaware, HSBC, JP Morgan, Loomis, and Malka Amit. Over the last 72 hours, the withdrawals have been concentrated in 3 specific vaults. JP Morgan's registered silver dropped from 19.8 million ounces to 11.3 million ounces. That's 8.5 million ounces, or 43% of their registered inventory, gone in 3 days. Brink's registered dropped from 14.2 million to 9.1 million, a withdrawal of 5.1 million ounces, and Delaware Depository saw registered drop from 12.1 million to 8.4 million, a loss of 3.7 million ounces. Combined, these 3 vaults account for 17.3 million of the 23.3 million ounce total withdrawal. What's significant about this is that JP Morgan is the largest silver short on the COMEX according to the bank participation report. When the vault that houses the biggest short position is hemorrhaging inventory, it tells you the short is scrambling to cover. Show chart. COMEX vault by vault registered silver breakdown with 72-hour changes. Now let's talk about the Shanghai Futures Exchange Premium, because this is the real-time indicator of physical demand from China, the world's largest silver consumer for industrial applications. The SFE premium measures the difference between silver prices on the Shanghai Exchange versus the London spot price. When Chinese buyers are willing to pay more than the international spot price, it indicates strong physical demand and tight supply in China. 72 hours ago, the SFE premium was 83 cents per ounce. High, but not extreme. As of this morning's Shanghai session, the SFE premium hit $1.47. That's a 77% increase in 3 days. Historically, when the SFE premium crosses $1, it's a signal that Chinese physical buyers are in aggressive accumulation mode. We're now 47 cents above that threshold and rising. What's driving this Chinese demand? Three factors. First, China's solar panel production is running at record capacity, and each panel requires silver. Second, China's electric vehicle production continues to grow, and EVs use significantly more silver than traditional cars. Third, and this is speculative, but I'm hearing it from multiple sources, the People's Bank of China may be directing state-owned entities to accumulate silver as part of their broader de-dollarization strategy. If that's true, we're not talking about temporary demand. We're talking about sustained strategic buying that will persist regardless of price. Let me show you something about industrial demand that explains why this supply crisis is not going away even if prices double. Silver is unique among precious metals because it has the highest electrical conductivity, the highest thermal conductivity, and the highest reflectivity of any metal. This makes it irreplaceable in certain critical applications. You cannot build solar panels without silver. You cannot build EVs without silver. You cannot build 5G infrastructure without silver. And unlike gold, where substitutes exist for many industrial applications, silver has no economic substitute for its key uses. Global silver industrial demand in 2025 was 638 million ounces according to the Silver Institute. Global mine production was 847 million ounces. That leaves 209 million ounces for investment, jewelry, and silverware demand. But here's the problem. Investment demand has been running at 250 to 300 million ounces annually for the last 3 years. The deficit is being filled by drawdowns from above-ground stocks, primarily ETF holdings and COMEX inventory. But ETF holdings are declining as investors redeem shares, and COMEX inventory, as we've just discussed, is draining rapidly. At some point very soon, we run out of above-ground inventory to fill the gap, and prices have to rise dramatically to either curtail investment demand or incentivize more recycling. Show chart, global silver supply-demand balance with deficit highlighted. Now let's discuss the short position and why the commercial traders are trapped. According to the latest disaggregated commitment of traders report dated April 15th, commercial traders hold a net short position of 261 million ounces in COMEX silver futures. That's a 9-week high and represents approximately 40% of the May contract open interest. These commercial shorts are primarily bullion banks like JP Morgan, HSBC, Bank of Nova Scotia, and others who provide liquidity to the market. In normal times, they hedge their physical silver holdings by shorting futures, or they take speculative short positions expecting to profit from price declines. But when you're holding 261 million ounces short and registered inventory just dropped to 48 million ounces in 72 hours, you're in serious trouble. To cover that short position, the banks have to either buy back futures contracts, which drives prices higher, or deliver physical silver, which they don't have in sufficient quantities. They're caught in a classic short squeeze setup, where both exit strategies result in higher prices. The only question is how high prices go before enough longs decide to cash settle instead of taking delivery. Here's what's fascinating about the timing of this inventory drain. We are seeing this massive withdrawal happen before First Notice Day, which is unusual. Typically, the big delivery demands and inventory movements happen during the delivery month itself, between First Notice Day and last trading day. The fact that 23 million ounces left in the 2 weeks before delivery even begins tells us that the large players are positioning aggressively and early. They're not waiting for the delivery process to play out. They're pulling metal now, which suggests they either have inside information about how tight supply really is, or they're intentionally trying to create a squeeze by reducing available inventory before the shorts can react. Either way, it's brilliant tactical execution by the longs, and the shorts are on their back foot. When you're playing defense in a commodity squeeze, you've already lost. It's just a question of how much pain you're willing to endure before you capitulate. All right, let's shift to the technical analysis because while the fundamentals and the COMEX data tell us why silver is going to explode higher, the charts tell us when and how that move will unfold. On the monthly time frame, silver is forming a massive cup and handle pattern that's been building since the February 2021 high at $30. The cup formed over a 3-year period from early 2021 through late 2023, bottoming around $17. We've been forming the handle since early 2024, consolidating between $23 and $30. Cup and handle patterns are powerful continuation patterns that typically resolve with explosive moves that exceed the measured move projection. The depth of the cup is approximately $13 from the $30 rim to the $17 bottom. When we break out above the $30 resistance, the measured move adds that $13 to the breakout point, giving us a target of $43. But given the fundamental backdrop we've just discussed, that's likely just the first leg. $50 to $60 becomes the realistic target for the full move. Show chart, silver monthly with cup and handle pattern annotated. The weekly chart is showing a breakout from a multi-year descending resistance trend line that has capped silver since the 2021 high. This trend line connected the February 2021 high at $30, the May 2022 high at $26, and the October 2023 high at $25. We broke above this trend line 3 weeks ago at $27.50, and we've since retested the trend line from above and held it as support. This is textbook technical behavior. Break resistance, retest as support, then launch higher. The fact that we're holding above the trend line despite the COMEX vault hemorrhage and the general market volatility tells us the bid under silver is extremely strong. Big money is supporting price at these levels because they know what's coming. The next major resistance on the weekly chart is the $30 level, which is both a psychological barrier and the February 2021 high. Once we clear 30 with conviction, there's very little technical resistance until we get to $35 to $38. On the daily time frame, we're in a tight consolidation between $28 and $29.50 that's been holding for 11 trading days. This is an ascending triangle pattern, which is a bullish continuation setup. We have a flat horizontal resistance at $29.50 and a rising support line connecting the higher lows at $27.80, $28.20, and $28.60. The triangle is tightening, which means we're approaching the apex where a breakout becomes inevitable. Based on the triangle geometry, we're approximately 5 to 7 trading days from the apex, which means the breakout should happen between April 28th and May 2nd. The timing couldn't be more perfect. May 1st is first notice day for the May contract. If we break out of this triangle right as the delivery period begins, the technical breakout will fuel the fundamental squeeze and create a feedback loop of buying pressure. The measured move for this triangle is approximately $1.70, which projects a target of $31.20 after breakout, but that's just the initial impulse. I expect rapid continuation toward 33 to 35. Show chart, silver daily with ascending triangle pattern and breakout projection. The 4-hour chart is where I'm seeing the most compelling evidence that a major move is imminent. We've formed a volatility compression pattern over the last 4 days, with Bollinger Bands squeezing to their tightest width in 6 weeks. The bandwidth indicator, which measures the distance between the upper and lower Bollinger Bands, is at the 10th percentile of its 90-day range. Historically, when the bandwidth drops below the 15th percentile, it's followed within 48 to 72 hours by a volatility expansion that typically moves price at least 5% in one direction. Given the bullish setup on higher timeframes and the fundamental backdrop, the odds heavily favor that expansion being to the upside. I'm also watching the average true range on the 4-hour chart, which has contracted to 0.38, the lowest reading in 5 weeks. Contracting ATR followed by expanding ATR is how big moves begin in commodity markets. When volatility compresses like a coiled spring, the release is explosive. Show chart, silver 4-hour with Bollinger Bands, bandwidth indicator, and ATR. The momentum indicators on the daily chart are setting up beautifully for a breakout. The relative strength index is at 63, which is firmly bullish but not overbought. This gives us plenty of room to run before hitting the 70 overbought threshold. The MACD has been in a bullish configuration for 3 weeks now, with the MACD line above the signal line and the histogram printing positive bars. More importantly, the MACD is curling up from a period of consolidation, which typically precedes acceleration in the underlying trend. The stochastic oscillator made a bullish crossover from oversold territory 8 days ago and is now rising through the 50 midpoint level. When stochastic is rising and RSI is in the 60 to 70 range, it's one of the highest probability setups for continuation moves. Volume analysis also supports an imminent breakout. During this 11-day consolidation, volume has been declining steadily, which is exactly what you want to see in a bull flag or ascending triangle. It shows sellers are exhausted and buyers are waiting for the right trigger. When the breakout comes, I'll be watching for volume to spike to at least 200% of the 20-day average. Anything above 300% would be a strong confirmation of institutional participation. Support levels are critical to monitor because even in a bull market, you get shakeouts and false breaks. The first support is at 28.60, which is the most recent higher low in our ascending triangle. If we break below that intraday, I'm not worried unless we close below it on a daily basis. The next support is $28, which is both psychological and the 30-day exponential moving average. Below that, we have the 2750 zone, which was the breakout point from the multi-year descending trend line. That's a critical level that needs to hold. If we close below 2750 on a daily basis, it would invalidate the breakout and suggest we need more time to consolidate before the next leg higher. But given the COMEX inventory crisis and the May 1st delivery deadline approaching, I think the probability of breaking down below 28 is less than 15%. The fundamental bid is too strong. So let's talk about where silver is headed and the specific timeline I'm watching. Here's my roadmap based on the convergence of the COMEX delivery crisis, the technical breakout setup, and the May 1st deadline. Between now and May 1st, which is 8 calendar days away, I expect silver to break above $29.50 and make an initial move toward $32 to $34. This move will be driven by two factors. First, the technical breakout from the ascending triangle will trigger algorithmic buying and momentum following from CTAs and trend-following hedge funds. Second, the final positioning ahead of first notice day will accelerate as longs who want physical delivery and shorts who need to cover scramble to adjust their positions. This is the accumulation phase before the main event. If you're looking to enter silver, the current $28.50 to $29.50 range is your last chance at reasonable prices before the squeeze intensifies. Show chart, silver with projected price path, and key dates marked. Between May 1st and May 15th, which is the heart of the delivery period, I expect silver to spike aggressively toward $40 to $50. This is when the delivery notices get issued, the shorts realize they don't have enough physical silver to deliver, and the scramble to cover goes into panic mode. We could see daily moves of $3 to $5 during this period. 10 to 15% single-day gains are very possible. This is not a normal trading environment. This is a squeeze, and squeezes don't follow normal price action patterns. They gap, they spike, they whipsaw, and they move in ways that terrify both longs and shorts. If you're holding physical silver through this period, just hold and don't panic on dips. If you're trading with leverage, make sure your position sizing is conservative, because the volatility will test your discipline. The maximum pain trade for the shorts would be silver hitting $50 right in the middle of the May delivery period when they have no choice but to deliver or cover at any price. From mid-May through the end of June, I expect silver to consolidate between $45 and $60 before potentially making a final extension towards $70 to $80 if the delivery crisis spills over into the July contract. Here's why this is important. If the May delivery period resolves without the COMEX changing the rules or declaring force majeure, it sets a precedent that large players can successfully squeeze the market by standing for delivery. That will encourage even more aggressive positioning in July, September, and December contracts. We could be at the beginning of a multi-month sustained squeeze where each delivery period adds fuel to the fire. Alternatively, if the COMEX does change the rules and forces cash settlement, it will destroy confidence in the COMEX as a legitimate price discovery mechanism for silver. Physical premiums will explode even higher as buyers reject the paper price and demand real metal. Either scenario is massively bullish for silver prices. The shorts lose either way. Now let me address the question everyone's asking. What about gold? How does the silver move impact gold? Gold is showing similar but less severe signs of physical tightness. COMEX registered gold is at 391,000 ounces, which is low but not critical. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently at 73. Historically, during precious metals bull markets, this ratio compresses as silver outperforms gold. In the 2011 bull market peak, the ratio hit 31. In the 2021 spike, it briefly touched 64. If we're entering a sustained precious metals bull market driven by supply shortages and de-dollarization, I expect the gold-silver ratio to compress toward 50 to 60. That means silver will outperform gold by a factor of 2 to 3 during the rally. If gold goes to 3,000, silver could go to 50 to 60. If gold goes to 4,000, silver could go to 70 to 80. Silver is the higher beta play on precious metals, which means bigger percentage gains but also higher volatility. For those asking about how to position, here's my framework. Core physical holdings should be bought now and held through the volatility. Don't try to trade your core position. Physical silver is your insurance against the monetary system breaking, which is looking more likely every day. If you want to trade around your position, use paper vehicles like SLV, silver futures, or silver mining stocks, but keep your core physical holdings separate. For exposure to the mining sector, I'm watching first Majestic, Hecla, Pan American Silver, and Mag Silver as the highest quality pure play silver miners. These stocks typically provide 2 to 3 times leverage to the silver price during bull markets. A 20% move in silver can translate to a 40 to 60% move in the miners. But mining stocks also come with operational risks, geopolitical risks, and management risks that physical silver doesn't have. Diversify across multiple names if you're going the mining route. Look, the bottom line is this: 23.3 million ounces of silver vanishing from COMEX vaults in 72 hours is not normal market behavior. This is a crisis unfolding in real time. The delivery crisis is not theoretical anymore. It's confirmed by the data. We're watching registered inventory drain to levels that cannot support the open interest in the May contract. The ratio of paper claims to physical silver has gone from concerning to catastrophic in 3 days. Physical premiums globally are exploding to double-digit levels. The Shanghai premium is spiking. Industrial demand is at record highs with no signs of slowing. And we're 1 week away from First Notice Day when all of this comes to a head. Every single indicator is flashing red alert for a historic squeeze that will rewrite the price of silver. The $40 to $50 targets I've given you are not speculation. They're mathematical projections based on historical squeeze behavior combined with the current supply-demand fundamentals and technical breakout patterns. If the May delivery period plays out the way the data suggests, we will look back at $29 silver the way we looked back at $12 silver in March 2020, as the entry point that people wish they had backed up the truck on. But here's the thing. Most people won't act on this information. They'll watch the squeeze happen. They'll see silver hit $40 or $50, and they'll say, I knew that was going to happen, I should have bought. Don't be that person. The data is clear, the setup is obvious, the timing is now. I've been tracking these markets for years, and I've called major moves before. I called the bottom at $17 in late 2022. I warned about COMEX inventory drains months before they became critical. I'm not always right. But when the evidence is this overwhelming, when every data point is confirming the same thesis, I put my full conviction behind it. And my conviction right now is that we are in the early stages of the most significant silver squeeze since the Hunt brothers in 1980. The difference is, this time it's not manipulation by billionaires trying to corner the market. It's the natural consequence of years of price suppression meeting record industrial demand while above-ground inventories drain to nothing. When supply and demand fundamentals reassert themselves in commodity markets, the moves are swift and brutal. Get positioned now. So what do you think is going to happen? Are we headed to $50 by mid-May, or will the COMEX find some way to change the rules and protect the shorts? How high do you think silver can go if this squeeze plays out? Drop your price predictions in the comments below. I want to hear where you think we're going and how you're positioning. And if you found this analysis valuable, if this deep dive into the COMEX data gave you insights you're not getting anywhere else, I need you to smash that like button right now. It helps YouTube show this video to more people who need to see this information before May 1st. Subscribe to this channel and hit that notification bell because the next 2 weeks are going to be absolutely wild. I'll be posting daily updates as we approach First Notice Day and the delivery period begins. You need real-time information because this market is going to move fast, and by the time the mainstream media figures out what's happening, it will be too late. Until next time, watch the vault data, watch the premiums, watch the delivery notices, and remember, physical silver is real money in a world of paper promises. I'll see you in the next one.